So good evening and a very warm welcome to all the guests who have logged in and who have taken their time of their busy schedule to have this interaction with us. So I wanted to kickstart the proceedings by giving a quick backdrop on how we started off JM's PMS business before we get onto our first of many webinars we wish to do with all of you periodically. So please let me introduce myself. I'm Rakesh Parekh. I've been instrumental in kickstarting this PMS desk close to 19 years ago now. JM has always been known to be one of the big homegrown financial conglomerates, providing a one-stop solution to all our clients. And our PMS is one such offering from the group. So I'm proud to say I take care of the discretionary part of the PMS, and I've been managing the same for the last 19 years. And we are also one of the few PMS managers who have a track record with such longevity. Before setting up the PMS desk here at JM, I was at Templeton Emerging Markets, co-managing one of their flagship funds in India, the Templeton India Growth Fund, TIGF, and also had the pleasure to work with Dr. Mark Mobius. A few years back, my colleague Vinay joined me to co-head the PMS team, and he looks at our NDPMS proposition. Vinay has over 2.5 decades of capital market experience, starting his career with JM Morgan Stanley, and then worked for over 20 years in Morgan Stanley, and then Enam, and now back to JM. So he will be the speaker for today's virtual conference. So I also have with me Ayappan, our head of sales, who will moderate this webinar. So over to you, Ayappan and Vinay, and please let's start.
Thanks, Rakesh. We hope to hear more from you in the periodic seminars that we look to organize. Before I kickstart the business end of the conversation, Vinay, we have been actually doing a lot of the seminars with distribution and investors. What we want to do is maybe kickstart the conversation maybe by asking a very pertinent question. How has been the India's journey over the last 10 years, in the sense that we saw 2013, we had a financial currency crisis, we had adverse balance of payment. And after that, it's been like 10 years and now we are considered a fastest growing economy. So how do you see the journey has been for the Indian economy?
Thanks so much, Ayappan. Thanks a lot, Rakesh, for the introduction. Let me start, with your question by not taking it for 10 years, but let me take it back 20 years so you'll appreciate how fast our journey has been in the last 10 years. In the year 2000, we were the 10th largest ranked GDP player in the world, coming below even Mexico. It took us 10 years to go to number 9 position. And then from 2010 to 2020, we notched up 1, 2, 3 places. And we became the 6th largest economy in 2020. So that was the metamorphic jump we had from 2010 to 2020. Now in 2 years, we've already inched up 1 more level and we are the 6th largest. The next 5 years, probably 5 to 6 years maximum, we would be mathematically becoming the 3rd largest economy in the world. And that's telling you how fast India is growing. Today, this year itself, India is accounting for 160 overall incremental growth in GDP. If it took us 60 years to get the first $1 trillion into our asset, it's taken us 7 years to get the next trillion, 7 years to get the 3rd trillion, and we're today a little above 3 trillion. And now it's taking us 3 to 4 years to go to the next $1 trillion each time, which means that we would be a $5 trillion economy by 2027, 2028. So we clearly one of the fastest growing economies. Having said that, our macro indicators are also very strong. Our total debt to GDP is about 180%, way below that of China, Korea, Thailand, and Brazil. Our external vulnerability risk, which is basically the simply put short-term debt over our strong forex reserves, are under 50%, which means we can really withstand pain or even take more debt. And our external debt is only under 20% of our total debt. So things are looking a lot more appealing and strong for India. One of the biggest risks we had historically was current account deficit, which had ballooned to 10 to 12% or at least 4 to 5% for a long period of time. That number itself is down to virtually non-existing. Sorry, I was talking about current account deficit, which had ballooned to 5%. That number itself is gone to virtually non-existing now, and all the balances are moving pro-India. Our exports are growing. Our net, what we are paying to the rest of the world, is coming down. Our overall fiscal deficit is inching down, and we are increasing our capex substantially. So for me, India is really doing very well in all counts. Beat that to something which we have a lot, the population. The demographics are auguring very well for us becoming a big consumption space, as well as India becoming a big manufacturing hub. Today, incrementally, we are adding one workforce for every 3 workforce for the rest of the world. So 25% of the workforce coming in the rest of the world is coming in from India, and they're all skilled, both English speaking as well as literacy rates in India are inching up substantially. So yes, we are a very, very big firm country and going leaps and bounds.
Thanks, Vinay. I am actually already getting a few questions from the panel and from the people who have logged in. My suggestion is that maybe what I will do is collate it at the end of the talk, and then maybe I'll just group it up and then ask you questions, Vinay. So now let's just go with the flow. You were talking about the Indian economy, but there seems to be concerns about the global economy. We are seeing the US having its own issues. We are seeing an inverted yield curve over there. What's your take on the global economy? I mean, is India completely insulated from it? Is India completely decoupled? So what's your take on the global economy and how India is insulated?
Thanks, Ayapan. So first and foremost, clearly there are risks of a global slowdown. The word recession has given way, and now everybody world over is talking about slowdown. Let's see why. Firstly, M2, or the rate of change of money supply in the world, let's start with US, is at virtually a 15+ year low. But the absolute M2 at about 20.7, 20.8 trillion is a big number, but it's down by about 0.9, 0.8 trillion from its peak. Now, technically, what's also happening is China, which had pumped in about $5+ trillion since it opened up, has also taken out about $800+ billion in the last couple of months. So you're seeing, some kind of QT happen, not just in US, but world over. Having said that, interest rates in US are very, very, very high. Also, the interest rates, as you said, are inverted, which means the 2-year interest rate is higher by almost 90 basis points over the 10-year interest rate. Just assume if you were taking a mortgage a couple of years ago, you would have been at probably 0 plus 2%. Today, that mortgage rate has gone to probably 7 to 8%. So for $1 million house, you were paying at one time $20,000. Today, you're paying about $75,000 to $80,000 a year, which is up by about 3 to 4-fold. So there is definitely stress in US. And India, on the other side, the difference between is 10-year and 2 years is a positive number, though a small number, and it's been lower at 7% compared to what it was historically, the overall 10-year chart. So we are really growing pretty well. If I look at just simple risk, simple parameters on the economy front, manufacturing index is expanding, a composite index is expanding, a service index is expanding, our IIP growth is rock solid, our CPI is falling pretty quickly, our forex reserves are inching up very positively, our trade deficit is falling, our GST collection is up in double digits and has been at close to all-time peak virtually. So India is doing something very right and growing pretty well as well. So pretty exciting. Now just spending a minute on China. China, though we see the indexes on a positive expansion mode, based on the way the GDP of China should grow, it's clearly not growing. And that is a key concern. Inventory levels in China are piling up. Real estate is becoming a reasonable issue. And I think the government of China, though it's cut interest rates, has probably to do a lot more to revive the economy a lot more further. Having said that, moving to your second part of the question, can India decouple from the rest of the world when it has already done so on the economy bit? Well, I think let's look at the past. Firstly, if I look at interest rates of US, you're close to 15-year highs. But in India, the interest rates, are pretty much lower than what it was in the last 15 years. It's in US, we're already higher than what we were in COVID times. Having said that, also what is interesting is when there are crises like the GFC or the COVID, India reacts like the rest of the world on interest rates. But when you come up on recovery, India does a lot better. Let's see what's happened in the equity market saying the same thing. The last time you had crisis in the GFC, the Indian markets fell a lot more than US. But the correction was a lot more higher as well. Similarly, in the COVID time, India fell a lot more. But look at the way the growth has happened. Mathematically, what India has done in the last big crisis, it grew from its bottoms, it more than doubled. And this time post-COVID, we've again more than doubled. But this time compared to GFC, when we were close to being a fragile 10, we are a lot more stronger on the economy. So I think my bet is yes, even if the rest of the world is having a slowdown, in India, we are a lot more positive and we are pretty confident that the overall both GDP as well as the markets should relatively to the rest of the world do a lot more better. But obviously, it finally will boil down to if the rest of the world sees a shock, India will see a lesser shock. It may just go nowhere for some period of time. Before I hand it over to you, just one more question, Ayapan, which I think is linked to the same story, which is the rupee dollar. Remember, if you were a US investor, you would have lost 4 to 5% putting money in India for the last 20-25 years. And I think that is changing soon. If you look at the Forex reserves we have, the Forex reserves plus the 1-year forward curve, we're today at close to 620 billion, close to all-time peak. And whenever Forex reserves keep on increasing, what really happens is the rupee depreciates and you get a lot more liquidity coming into the banking system and the capex cycle takes off. Also, why are the Forex reserves moving up? One key reason, apart from commodities, is now Russia accounts for 45 to 50% of our net oil imports. That clearly tells us, A, we're not paying crude for about half our requirement in dollars as of now, and B, we're getting it cheaper as well. So it's kind of a win-win situation for India as a whole.
Good one. So Vinay, I think you spoke about the Indian economy and then you gave a perspective on how India is decoupled or India looks like is decoupled from the global economy and what is the situation in global economy. But coming to the Indian markets, okay, I think we have a very catchy title as well, that 25,000 at 2025. So what's your take on the valuations from a domestic perspective? I mean, are we like too much overheated or are we still in the valuation zone, which is like comfortable to enter? So what's your take on the valuations and the Indian markets?
Sure. Thanks a lot. So I'm going to break this question in a couple of small charts, which I'm going to show the team. Firstly, when we believe the Indian markets are overheated, I'm not saying you said that, but since the Indian markets are at or close to their peak, let's start by saying that Nasdaq is not at its peak. It's about 10 to 15% below its peak. MSCI EM is 25% below its peak. So is Russell 2000. So it's Indian markets which are closest to their peak. And that's why this question is really very relevant. FITD, which is our fiscal year, we are virtually the best performing market in the world, especially our mid cap and small cap sectors. They're virtually the best performing space, even better than Japan, and then followed by Nasdaq. Having said that, if I were to look at just this year, the year 2023, you've seen Nasdaq move up 33%. You've seen Japan move up 23%, and India is just about 5-6% higher on an MSCI weighted. So we have a lot of catch-up impact and a lot of froth factor on valuations is behind us, and earnings visibility in India is a lot more higher. Having said that, something very, very interesting, since I mentioned earlier about foreign, Forex and the dollar. At one time, global investors owned as much as 20% of India. Today, that number is only 18%. This is despite the $18 billion of inflow we've seen this year, this fiscal year coming, largely because in the last 2 fiscal years we saw a lot of outflow, and the rupee went from 70 in the last 2 years to about 82. So I think there's a lot of FII buying technically, which will come up into the country as well. As far as the MSCI weightage is concerned, one more technical point, India has pretty much been around here itself, where it is, which is about 13 to 14% for some period of time. It's not caught up if investors were looking at China, not doing too well. It's not caught up to, let's say, a 20-25% number as far as weightage for MSCI is concerned for India. So I think there's a lot of catch-up impact, and I would do injustice if I don't tell you that retail India is literally rocking as far as the Indian markets are concerned. You're today seeing as much as $1.5 billion of inflow coming to the country. Now moving to the question of valuation, we are today at a 5-year average, 20 times 1-year forward earnings. Yes, we are at some premium to MSCI EM, but that premium has reduced from 100 plus levels to about 64 levels. And also compared to the rest of the world, the premium has reduced very quickly from 50% to 16. Now, why has this happened? This has happened because of 2 reasons. Though we are at a peak, our earnings has been inching up where the rest of the world's earnings have been going down. And secondly, if you look at it one way, we've had a time correction on the overall market because it was last October where the markets were peak. So we've had some time correction also, which has happened. Now, let me run you through some maths. Let's assume that the index multiple is at 20 times. And, our analysts talk about a 19% CAGR in earnings from F23 to F25. Putting that down, our 1-year forward EPS goes from about 815, 820 to 990 to 1,160 and then 1,345. So if we were to sit 1 year forward and put a multiple of 20, we would see an index of 23,000. And if you were to look at 2 year forward, we see an index multiple of as much as 27,000, which means with an 18-month profile, when we start somewhere in 2025, you'll probably see a 25,000 index, which I think is a lot more appealing if you are waiting for an 18-month profile. Having said that, the earnings visibility which would be coming in would be a lot more coming in from the capex related sectors, from telecommunication and the auto sector, as against historically it was only the banking sector which was driving growth. Now I think, with post-COVID, though the banking sector will still be solid in overall growth, the decline would largely come not in the overall numbers, but in the growth rate would largely come because now your provisions of COVID are behind you. And as the loan book grows, the overall financial and banking sector would do relatively well, but not as well as before. But you'll have a lot more money coming in or a lot more earnings coming in from the telecom sector, which has turned around, from the capex sector, we're seeing lots of order books go up, as well as the automobile sector. So yes, we are pretty excited about earnings, and we think a 25,000 index in the next 18 months is very visible.
I happened to see a couple of interesting charts, Vinay, while you were presenting this valuation slides. One of them which I observed was that the 3-year returns for the mid and small caps were higher than the large caps. And I think it is the same case even for this current financial year as well, So is that trend likely to continue? That's number one. Number two is that the slide that we have right now on the screen is telling that there's a lot of the sectors like your cap good and construction material, industrials, telecommunication, the automobile, all of them are not in the largest sectors, So what's your take on where could be the pockets of return? I mean, is it on one side you said 25,000. Do you think that the small and mid caps will also equally come to the party?
So I think, on the contrary, they'll probably beat the party. And let me tell you why. See, it's, we always learn this first lesson when we look about wealth creation is bet on assets. Asset allocation is key. Now, what are we saying in this slide is the capital goods sector is going to have very high growth in earnings. The telecommunication sector is going to have high growth in earnings, and auto, especially the components part of the space, would have high growth in earnings, followed by some parts of health, healthcare or pharmaceutical, followed by some parts of metals and minings, which has had a tough last 3 years. Now, technically, what we are saying in a way is that the large cap banks, which were growing substantially, will not grow at the same rate. So if I were to look at those indices which have less ownership or less contribution coming in from banks and more contribution coming in from capex related sectors, that space would do a lot better. And I think that's exactly why we are betting on micro cap, mid cap, and small cap. If you look at the micro cap sector, 50+% comes from capex related companies. If you look at small caps, 40+% comes in from the small cap space where we think earnings are growing, and 35+% in mid cap. As against, if you look at the broader base, the Nifty 50, the smaller based index, but large caps, your growth coming in from just contribution coming in from capex related companies is just 26%. That's largely dominated by the financial space. So if you're saying the financial space will slow down in the next 3 years and the rest of the space will grow and look a lot more domestic, I think this is the space where the earnings growth will be a lot more than the earnings growth in the large cap. So in my eyes, India will beat the rest of the world. Large cap will probably beat the rest of the world, but mid cap and small cap will continue beating the large cap. And that's why you need a free mix of the overall portfolio. Having said that, one word which Rakesh told me, which I'm going to just quote him, is this is the time you need to be looking at stocks a lot more than just the index numbers. So it's a stock pickers market a lot more than anything else.
Okay. Vinay, I think this, again, you just briefly touched upon it, but I think it's a very broad topic, I would say, is asset allocation. You were just telling about how to do the asset allocation. Now that you're telling equity as an asset class looks good from a 2, 3, 4 year perspective. So how would you do an asset allocation here? I mean, how would you do an asset allocation on the large cap, mid cap, small cap? How would you play the markets?
So, Rakesh is actually better poised to do it since he does discretionary. But, our perspective is today 50 to 60% of the overall allocation should be on the large cap, and about 40% should be on mid cap and small cap space. But those mid cap and small cap spaces, which are going to become large cap of tomorrow, you want to get that stock which is tomorrow's large cap. Which is the Bajaj Finance, which you're going to discover today, which was the Bajaj Finance 10 years ago. So that's really where you need to look at. And then you've got large cap becoming a better constitution. Every client is happy. Having said that, just one more comment out here. What we do at JM is, we are very proud of our team of 190 plus years of experienced professionals all together. And we build models ourselves. We look at the sell side, but we build models ourselves. We look at spaces where we are excited on and then build it from bottom up. So even if it is a large cap sector, let's say financial, or strictly a large cap sector, we would be looking at winners there where we think there are a lot of undervaluation coming in. So that's how we will build our portfolio. So in large caps, we will take a lot more understanding of the space of where we see the money is to be made. But in small and mid cap, what we're seeing is the markets itself or the industry itself is growing a lot more than what one had figured out. So that's where the growth is getting a lot more stronger.
Okay. I think that it's a very, a leading question in the sense that you were talking about the foreign exchange reserves swelling up, probably the Indian rupee appreciating. The question now comes is that how would you play the portfolio in the sense that where would you actually be overweight, underweight? What are your key sectors that you would look to play both as an underweight and an overweight strategy, or maybe a EQ weight strategy? One, and number two is a few questions have already come on IT as a sector, probably leading from the conversation that you had on the dollar. So maybe if you could touch upon maybe the IT as a sector,
sure,
it would be good.
So So, the way we would look at it is, as we said, we are getting a lot more excited on capex related sectors. So for us, industrials and capital goods sectors, we are a lot more overweight. That's our biggest position of overweight, followed by specialty chemicals, where we are overweight. So we're taking one wherein the P is really run up and one where the P is running down. Where are we getting our money from? Though we are equal weight in banks, because most of our non-banks and banks put together, since we are using the last month's data, is largely in the banking sector, or companies like HDFC Limited or the warrants, which are just getting converted. We are actually underweight the non-banking space in the financial sector. Moving on, where else are we overweight? We are overweight, as I said, capital goods and industrials. We are overweight telecom. Where we are underweight is technology and IT, as you mentioned, and the energy sector. These are our funding sectors altogether. Now, taking your first question on why IT, why are we underweight IT? I think the first thing is we think that the dollar can be under 80. If RBI were not to touch it, the dollar would be under 80 today. But even in the medium term to long term, we think the dollar would be under 80, courtesy our swing factor, which has come from crude oil. So that's step one. Step two, we are seeing the rest of the world, if there are any correction on the labor front, it's largely happening on the services, especially the software services front. Also, let's not discount things like ChatGPT and AI, wherein what we are seeing is there is a lot of, as we saw in IT earlier, when conventional IT took way for digital, there was a time span, it took for moving to coming back to a growth of 8 to 10%. I think the IT industry is in that same wave. So we are underweight there. But underweight at one point of time was a lot more than what it is today. And in our underweight calls, we are looking a lot more at those spaces where we get some kind of contributions coming in on companies which are linked to AI or the EV sector. One such company is KPIT, which we are looking at a lot more excitingly. Obviously, there are a lot more names, which have become in valuation terms exciting, but we are buying a lot more mid cap than large cap spaces in the IT sector. There are three themes we are largely paying. One is the financial consumption theme. The second is the capex cycle theme, and the third is the Make in India theme. I'll dwell on it a little later, based on the questions really you get. So let me stop here and give it back to you. But just to address it to you that we are largely overweight capex. We are largely overweight the domestic sector, underweight the global facing sectors because of our view on the currency, and financials and energy and IT are funding wherever we are overweight.
Vinay, would you want to briefly maybe give us some perspective on this China Plus One story? I mean, is that still is that something robust, or what's your view on sectors which are getting benefited from the China Plus One? What's your outlook on that? Sure.
I'm going to fine tune your question to why China Plus One, but why not Make in India story, right? Let's just make it even broader, right? So today, obviously, the world is fixed on China and what is replacing China, but let's not forget, China is huge in terms of infrastructure. It's very difficult to replace China. But I'll tell you what I didn't know earlier. There was a time wherein India was consuming a lot of defense equipment from China and Russia. And then, the Indian government started coming up with its overall scheme of being Atmanirbhar, and defense consumption had to start becoming a lot more indigenized. As a result of which, we got new stories come up in the defense industry. So this, in a way, is a China replacement story for India. It's a Make in India story, which is replacing exports. So that's what, for us is a broader play to play with, one is defense. Moving to the second space, again, in the Make in India story, obviously, I spoke about IT and, the EV angle of auto. Totally a single story, which, as EVs go up, one of our companies we are very proud about, KPIT, is focusing virtually only in the auto sector. It's got an order book of, in the last 4 quarters, if I had to add it, it's equal to 2.2 times their last year's revenues. When we thought the order book from Honda had become small at $400 million and they would take some time to get some other bigger orders, they got another $200 million order in the next quarter, and really making us feel that, wow, you're seeing a lot more orders come into the picture. When we're saying the IT sector slowing down, this company grew 8-9% QOQ and 45+% year on year. So high growth space, a Make in India story, but in the IT space. Then defense, I already mentioned. One of the sectors which is totally beaten down is the specialty chemical sector because there's a lot of inventory in China which has not been consumed. But one of the most efficient names in the specialty chemical sector, where the raw material price is virtually like water, is Archean Chemicals, where you get money coming in, where you get its raw material coming in from the Gulf of Kutch. The costing is not much. The company is net cash and already a return on capital employed of 25-30%. So, a Make in India story in chemicals. There are many more names in chemicals like Tatva Chintan. Another big name in the Make in India story is MTAR, which makes clean energy based boxes. This company has got 70%, close to 70% of its orders coming in from a single company, Bloom Energy, a global company which is listed, which itself is growing very strongly. And the company's order book is very strong, and 30-35% of its revenues are coming in from defense, from cement, which itself is growing pretty aggressively. Again, a lot of exports coming in out here, and I would not do justice if I don't talk about Tata Motors. There was a time when people spoke about Tata Motors, people were concerned on Jaguar or JLR and its debt. Today, JLR is FCF positive. Next year, it would be net debt negative, which is net cash positive, the entire company, and stocks at 4 to 5 times EV/EBITDA. So yes, we are excited on a lot of Make in India and export stories, or those replacing imports.
Vinay, we got a few questions coming up on the chat board, but maybe what I'll do is I'll club it together. See, the question that is coming is, the capex cycle, or for example, the industrial cycle, post 2007, 2008, we have actually seen a slump of that cycle, and every time there is an opportunity, it looks like almost like a false alarm, in the sense that will it ever rise? Will it ever deliver? So while you're talking about this capex cycle, how is it so different from what has happened in the past? One. Number two is that the question that has come on the chat board was the defense stock seems to have skyrocketed, I mean, in the sense they have gone up pretty soon, pretty fast. So what's your take on that? I mean, is it has it run up too much, or you feel that there is more legs to it? So 2 parts to the question.
Sure. So let me take your first question. I have a slide for it somewhere. Let me just find it first. So, this comes from our rocking analyst, Rahul. He's done a lot of work with Amish and built this slide, and I really like this slide. It kind of gives you the answer. These 2 slides. Let me first take the second slide first. If you look at who provides capex, to the overall country, the first is obviously the government. The second is the government-owned PSU companies, and the third is the corporates which are non-PSUs. Now, the non-PSU corporates, we cannot take a breakdown and be very clear of what the capex can be of theirs. Obviously, we can take guesstimates. So let's just look at what is written and recorded and given to everyone in terms of data available for the entire street and coming from the budget. And in the budget, you get the government budget numbers coming in water, railway, defense, roads, and others. Since you mentioned defense, let me just take the defense question first. At one time, 10 years ago, there was about 800 billion rupees as an outlay given by the government, and a lot of this went globally. Today, about 1.6 trillion, or 2 times that size, has come up by the government on a year-on-year basis, and a lot of that, almost 40+% of that, comes domestically. So domestic share of overall capex has gone up, and the overall capex in defense has doubled. So it's in a way saying that you've got 5 times, 6 times more size come up on capex for individual companies. So that's step one. It's interesting. One of the companies which came out with results, Bharat Dynamics, missed its results. and the stock's not down much despite having a run up for I think only one reason. And the reason is they had a supply constraint for being able to execute an order, which is a positive problem to be in, which means you have an order. As soon as you get the supply, you'll execute it. Now let's look at another sector, railways. Again, some stocks there like Titagar have gone and hit the roof. But what do you do if that sector has seen a 7 times growth in the overall size of outlay which the government has spent? So from 240 billion rupees, now the government is spending about 1.7 trillion rupees on a yearly basis. Then look at water, and there are virtually only 2 companies largely which are playing the water cycle. That number has gone from 140 billion to 990 billion. Again, a 7x growth. So I think it's the growth of what the government themselves, leave aside corporates, leave aside PSUs, are doing in the capex run cycle, that you're not depending on outsiders. I mentioned India's demographics are growing, and 1 in 4 people who are educated and literate are coming in from India, and the workforce is going to be really swelling from India. What I told you, if I tell you different words, we're adding a Zimbabwe in a year in terms of population, and we're adding a Singapore in a year in terms of efficient skilled labor, right? So that's where I think the government is focusing on giving them jobs and keeping them. That's the importance of capex, and as you can see that in the outlay. So yes, it's very important to see the cycle today compared to the cycle 10 years ago. In a lot of spaces have grown 5 to 7 fold. Overall, the growth has been 5 to 6 fold. So that's super amazing. I didn't mention roads, which has gone up 17 fold. It's just crazy, right? You're today building as much as, I would say over 5+ kilometers on a daily basis. That's crazy numbers coming up. Now, if you look at the other thing, what's very interesting is in the capex companies, the number of orders you're getting per year based on sales has gone up from 1 to 2 years of sales to 7 to 10 years of sales for some companies. So you've got some companies with a short cycle earnings orders. That's where the ABB, Siemens, Hitachi's and Honeywell's place. And then you've got the railway rolling stock, where you have companies which have got a 7 to 10 year cycle, and the defense comes here as well, in the 7 to 9 year cycle. I think as your cycles increase, it's just a supply constraint which you're playing with and your balance sheets are rock solid, you're looking at companies which are really going to do well in the future. Sure, a year ago they were at 8 to 10 times P. The earnings have grown and today they're at 20 times plus P. But the earnings trajectory, not for 2 years, but for 5 to 7 years, which is where we can see the order book today, seems to be a robust 15+%. I mentioned 15+% because you got companies like Hindustan Aeronautics, which would be in the 12 to 16% CAGR, and you'll have companies like Bharat Dynamics or Electronics, which will be in the 20 to 25% CAGR. But all these companies are seeing robust return on capital employed of 20% plus, reasonably strong balance sheets, and good order books and growing. So yes, we are excited about capex, and I think, as they said for Maggie, this time it's really different.
Thanks, Vinay. I think probably maybe I'll just take a continuing question is, in all these sectors, the counterparty is always the government of India, right? I mean, be it railways, be it your defense, be it your water treatment plants. We are getting on to an election year. Okay, and we are having a few state elections also coming through in the next few months. What's your take on this? I mean, how does an investor play this? I mean, do you think that India, maybe probably an investor could get some opportunity to get in? And will this entire road get derailed if, let us say, there's a new government coming in, So maybe one question, but in 2 parts.
Sure. See, there have been very strong reforms like manufacturing reform, wherein taxation is 15% for new companies to come in, one of the most efficient and low tax arenas which India could never be proud of historically, which have already paved way. Now, whichever government comes in will come in because of the vote bank. And how would you tell the vote bank we are increasing taxes for the manufacturing sector? Similarly, whichever government comes in, they need to take care of capex because they need to get jobs in the country. To get jobs in the country, again, can you reduce your defense based on what geopolitical risk we've learned from Russia as well as Ukraine? Can you reduce the number of roads you're coming in? I said 5 kilometers a day. It's actually 50 kilometers a day is what India is growing. That's been the tenfold growth which India has seen. So you're seeing so much of change which India is seeing. You're seeing the capex cycle come up. I think any government coming in can only do one thing, which is press the pedal more and say that, see, this is why you elected us. You elected us to increase the earnings growth for India. See, there was a time where corporate earnings were under 2% of overall GDP. Today, they're at 4.5%, and we can be saying, wow, they are at 4.5%. But US is at 9 to 10%. So we've got doubling of profitability to come in. And for that, what the Indian government can really afford doing is spending more on capex. So I don't think there is a chance for the government to want to reduce its capex. But yes, in the next 12 months, you may see the budget coming in as an interim budget till the new government comes in. Difficult to see them want to grow the capex. They will say, probably keep the same philosophy as the earlier. And you'll see yet robust capex numbers come up, which is good news. As long as there's nothing populist coming up, because that hurts the fiscal deficit. We want the fiscal deficit if it's going to be more negative coming in purely from capex, and that's what this government is showing. So I think it's difficult to see, the trajectory of India Inc.'s earnings go sideways for a long period of time. But yes, next 12 months is elections, and people want, some bad news to get in again. That's what they may get. Based on whatever volatility comes in. I don't even know whether I should use the word bad, but more volatile news will come out. Having said that, the earnings trajectory, look at the way the earnings are coming up. We said the banking sector in the future would slow down, but guess what? You've seen a 40% growth in the banking sector for stocks which have come up so far. The non-banking sector is singing, and you're seeing high growth coming from there as well. So as long as the overall growth trajectory is over 10 to 15%, India is way higher than the rest of the world. There have been only 2 cycles where you've seen over 3 years of 10% growth come in. The first was a 2003 to 2008 cycle, and now is the one which you're doing in. And in the 4th year consecutively, we are probably seeing a 15 to 20% growth this year, and that growth's only growing. So I think the Indian investors in the global world are finally seeming to see India's earnings growth come up. And now it's not about just P re-rating, which is what I think is here to stay.
Okay. Vinay, I think 2 questions coming in. One is more on the macro, and then it is pertaining to the services that we offer, in the sense that what are the range of products that we offer to the clients. But before that, one question on the macro, which has come up on the chat board, is the vegetable prices seems to have gone up. The crude silently has gone up by around $10. Okay. And also the US rates have also been inching up. Do you think the interest rate cycle in India is also going to be like higher for longer types? So one, inflation, and number 2 on the interest rates. And then maybe if either you or Vinay or you or Rakesh can take up what is the services that we actually offer.
Sure, I'll take the first one and I'll ask Rakesh to talk about our products. But see, as far as vegetable prices are concerned, remember on a year-on-year basis, the good news is we've had good rainfalls. If you had spoken to me last month, I would have told you, guess what? El Nino, our pharmaceutical analyst Sudarshan had highlighted, was something to be concerned about, which now with courtesy rains, he himself says the impact is largely behind us. You've not seen, good results come out in the agri space, but most of the news is that rains are good and things are not going to be as bad as expected. So we're seeing even vegetable prices come down sooner than later. Having said that, the overall commodity price of crude going up from 70 to 80, 85. What has it gone up for India on a year-on-year basis is actually it's declined by 20 to 25%. Just because we are consuming half of our imports in Russian crude. The interesting thing about Russian crude is it's not just at a discount. As the crude prices go up, the discount increases. When crude prices were 70, we got only a $3 to $4 discount. When crude prices go up to 80, 85, you get a discount of over $10 for the Russian crude. So the Indian government, gains relative to the rest of the world in a higher crude oil environment, and that India is not used to seeing historically. Also, what's really interesting is Russia is not taking dollars from India as far as crude's concerned. It earlier took rupees, then it's taking dirhams, and it's taking Chinese currency. So you're technically not paying dollars, so your dollar is also strengthening. So my perspective, inflation worries are largely behind us, and because we are not paying as much of dollars to the rest of the world, and our exports, though we say IT is doing bad, on a year-on-year basis, we're still growing at 8%. QOQ, we are 0 to -1-2%, and as Manju, our analyst, tells us, this is something as sticky in a year like this. It's superb news, and I agree with her on that. That you're seeing the IT sector not decline, you're just seeing it go flat on a QOQ basis. So keeping both these in mind, I don't have as much concerns of India wanting to increase the interest rates or keep it high. The question is how high for how long? It's a function of if you reduce the interest rates in India and the interest rates in US are long, there'll be a trade of people putting money in US because that's where they'll make a lot more money. So that is why probably India's interest rates will fall once US starts falling rates, which could be somewhere in December, January. But for the next 6 months, I think it's fair to assume a pause, but no increase in interest rates in the country. So the story which you were telling investors earlier that leveraging is a big problem for the country, for any country, that too is inching down. If you look at even our financial analyst, she tells us every call which has been recorded by banks coming up, the NIMs have reduced a little bit because you're seeing deposit rates move up. But everyone's believing that that's close to peak NIM reduction, maybe one more quarter more, and you'll be smiling even as far as NIMs are concerned. I hope that addresses upon your first question.
Yeah.
Rakesh, would you mind taking the question on products?
Sure, I'll do that. Thank you, Vinay. So I happen on the and guess on the product part of it. I think when I mentioned on our introduction, we've been doing this PMS for close to 19 years now, and obviously we started off predominantly on the discretionary products and the discretionary portfolios. Subsequent to that, we also launched our NDPMS product, which we have also expanded and made it a lot more focused now going forward with the addition of more analysts in our research team. So I think we've really put that into a different type of avatar now on the NDPMS side. Just very quickly on the DPMS or the discretionary PMS. Again, we have 4 products, each having more than 5 years longevity and track record. Our oldest scheme, was launched in 2005, and that also has some decent compounding over an 18-year plus period. One of our products, Focus, a multi-cap product, we launched 12 years ago. And then we have 2 relatively more mid-cap focused products, mid and small cap orientated schemes, which is the IRP3 and the opportunistic. And again, both of them, have more than more than 5 years track record. So all in all, fairly well spread out on the discretionary PMSs, straddling between a larger cap, which is our growth and value product, 2 multi-cap products, which is our growth and value, which is our focus product, and the opportunistic products and a flexi cap, which we have in the IRP3 product. So that's how we are positioned. As far as the NDPMS platform is there, obviously these now we are catering to much larger ticket sizes compared to the discretionary portfolios. It's obviously a much more interactive experience. with the clients. And I think our USP is our research team, where we can leverage their expertise and their experience. And we believe that clearly also adds a lot of value to our clients on the NDPMS platform. So I hope that answers your question, Apan.
Yes, thanks. Thanks, Rakesh. Vinay, would you want to actually just maybe briefly give the team? Yes, I was about to ask this question, and thank you for reading my mind. So just maybe we have another maybe 5 minutes for the webinar to conclude. So if you could just briefly maybe give the team and maybe give the closing remarks, and we can conclude.
Sure. Thank you, Rakesh. Thank you, Epan. So, as we said, our DNA is our team, both sales and investments. I'm only talking about investments out here. So clearly, Ayapan's built a fantastic sales team as well. So I'm not talking about them out here. Having said that, as far as the equity investments are concerned, we've had the advantage of getting multiple people from lots of places. We have got Manju Bashni from Sundaram. We've got Sudarshan from Sundaram. Manju takes care of our IT services and technology. She has over 15-16 years of experience. She herself is an engineer as well as an MBA. Sudarshan on the other side again has a good 15 years of experience, and he's done his MBA as well. Moving on, we've also got Mansi, who's come in from Morgan Stanley, her previous stint, and she was working with her husband in NBFC with over 13 to 14 years of experience. We've had Shreya, who's a data science analyst who's got 2 years of experience. We've got Ghazal, who covers oil and gas and telecom, who's worked in one of the firms which was largely in the buy side, so more like a value-added service firm. She's done an MBA in finance herself. We've had Anirudh, who's had more than 20 years of experience in the equity capital markets, and he himself is a CFA as well as done his Masters in Finance and an MBA from IIM. We also have Dharmendra, who's got over 2 decades, close to two decades of experience in the buy side. He's been with us from a long period of time. We've had Rahul, who we recently hired from Anand Rathi, and he's got a lot of good names in engineering and capex. Only one lighter comment I'll make on him: the poor guy, since the capex industry is doing well, is getting white hair very quickly. We've had Mukund, who covers the defense space, commodities and capex, and we got him from Morgan Stanley as well. We have Vinamra, latest hire from Ernst & Young. He was a quant analyst out there, and he's helping us out here as well. One of our integral parts of our team is Amish, who's our investment strategist, fund manager, and he helps all our analysts as well on the overall story, so that small cap and mid cap stocks where we build models where we can't get through the companies and we've got little less coverage, that's where he steps in and becomes an analyst by heart as well and helps the team up. So very proud of our overall team, both in sales and research. The 3 or 4 key takeaways we want to leave behind to you is: don't look at the absolute market valuation today. Look at India being a growth story. Don't differentiate the second point between small cap, mid cap, large cap. Look at stocks, look at your portfolio in totality, look at domestic India more than global India. 3, the earnings growth, as that increases, at least that based on, forgetting the word time in the market as against timing the market. If you're there for longevity, if the earnings growth in India is 15 to 20% and inching up, that's something which we all would want to hope the Indian markets also do at whatever period of time we come in over the longer period. Play the right themes, do the right asset allocation, even in equity, buy growth at reasonable valuations. Don't go by herd mentality, do a lot of research, and that's what we all do. And I'm sure all of us will be a lot more richer in times to come. Over to you, Ayapan, and thank you very, very much, team, for joining us in this call.
Thank you so much, Vinay. Thank you so much, Rakesh. And I would want to take this opportunity to thank each one of you who have logged into this call. We want to use this platform to communicate more frequently with you. Please do write to us. Please do contact us on what are the topics that you would be keen to hear from us, and we'd be more than happy to actually provide content. So thank you once again, and we look forward to the next interaction. Thank you so much. Thanks,
Thank
Vinay.
you.
Thanks, Rakesh.
Thanks. Thank you, everyone.